This video is going to cover the price action for the Emini today. Yesterday we had a very big sell-off, and you always have to wonder if, as Al says, 50% chance you get a little bit more down within the first 2 hours. I forget what the exact probabilities are. 25% chance you get an immediate reversal of the move, and 60% chance, 70% chance you go sideways on the open. Now, don't quote me on what the exact probabilities are, but what does that mean? Well, that means that if the day would have closed over here, very high probability we'd go sideways. Now, since the day opened here, we were already sideways for quite a few hours, so it lessens the need to have to go sideways more. However, we have a trend line break sideways. So anyways, I had a trend line break, two-legged pullback. You can argue this is enough to make the probability 50-50. So either way, sideways for quite a bit of time. And on bar one, if you're doing anything, it's buy above bar one, stop below. Kind of do this, it's just easier so we can see the price action. So it's a buy above, stop below. Decent follow through on bar two. However, what do you notice? It's the biggest bull bars late in the bull trend or rally. So increases the chances of exhaustion. So odds are though, you'll get a second leg up. And here's the first reversal attempt. We rallied, here's the second. If I was long, I'd get out. I'd certainly get out of longs below this bar. Bear bar, but bad follow through, increases the chances of more sideways. And we started to sell off, couldn't get below this low. And we got a bull bar, so you can argue your wedge, 1, 2, and 3. Two things to note. The bulls that bought here, although this probably wasn't that great of a buy, it's a strong enough surprise bar, you may get a second leg down. So the bulls that bought here, they didn't have a chance to get out break even, which means because it's probably a trading range, they probably will get the chance to get out at break even if they use the wide stop. So some will buy, use a wide stop, maybe down here. I think less will do it right here and buy more above a bull bar, or buy more on a lot of bear strength, and they'll get out up here. So decent bull bar but tight channel, may get a second leg down. Bad low one short, or you can say that's the low one short. Either way, it doesn't really matter. And then you get a bull bar closing on its high. Therefore, that's probably a reasonable buy. Like I said, probably a reasonable buy. You can maybe put a stop below here, maybe below here, arguing that if you get a breakout, it may collapse, but that probably won't happen. So if I was short, I'd probably get out of shorts above that bar, worst case. Definitely get out there. It's an okay buy. You can call it a 5 or 6 bar micro channel. Odds are the first reversal down will fail and will go up. But it's a sign that there's not a lot of urgency to buy. Second leg up, bad follow through. Bad follow through. So for the bulls, they can get out below. It's probably going to be some sort of trading range, tight channel. Probably going to have to go sideways more. And you can see it's triggering, but the bears aren't getting the bear breakout. And that's a lot because there's not a lot of energy right here. Traders see it as the middle of the range. They see it as the high of this strong by the close bar. So really, when you see this, it's better just to get out, wait for more. You're not going to, the odds are there's a 50% chance. It's a triangle, so there's a 50% chance you get a bull breakout, 50% chance you get a bear breakout. So one thing Al mentioned in his weekly write-up was that you always have to remember in a tight trading range, there's also a 50-50 chance the first reversal fails and you get a second leg. Or excuse me, the first reversal fails, so you get a breakout to the upside, it fails, and you go down. And there's also a 50-50 chance that the bull breakout fails and reverses. So what that means is if you buy, you put a stop down here. Well, there's a 50-50 chance it gets stopped out and it goes your way ultimately. So it makes the math somewhat difficult. You can call it a double top, tight trading range. Some traders will sell, put a stop up here, and bet on some sort of major trend reversal. When they see that, they get out quickly. Others get out above the bar. Weak follow through for the bulls, starting to travel up, and then we get a big bull bar, big follow through bar. Strong enough, odds are you'll get a small second leg up, could be by the close. It's also very late in the bull trend, so you have to wonder, this may fail. So if you buy where you buy and then you're disappointed, what are traders going to start doing? They're going to start scalping out, and this is why this happened. So if I bought, I may not get out here. I'm going to be disappointed. I see this, I'm just going to get out and wait to buy again. And you can see right here, buy the close bulls, disappointed. They buy more lower, try to get out of break even. And here we are trying to sell off, tried to become sell the close, started to fail. With this bar, a lot of bulls, a lot of bears, if they sold the close, will get out above the bar. And you can see it's basically what happened. And that was the end of the day. Overall, interesting day. When you get a strong breakout like this and follow through, the odds are smaller. You're going to get a bear trend. So even if you fall below here, probably will find buyers. So it makes it more likely a trading range. When you get a bull breakout and you get a deep pullback, the odds are if you get back to it, it'll be a trading range. The odds are if you fall below it, it'll be a trading range. And yeah, that's pretty much it. Hope this video helps.